welcome to Stringham Real Estate Edge. Today's guest is Brad Baldwin, President and CEO of First Utah Bank. Brad, thank you for being with us.
Thank you, Garry. It's nice to be here.
Brad, you're an attorney, you're a banker. What part of your career came first, your legal or the banking side?
Well, I've learned, Garry, there's lots of accidental bankers in this world.
Indeed.
So I went to the University of Utah, majored in finance. I thought about banking as a career. I realized it didn't pay very well. So I went to law school in Seattle, Washington.
I see.
I got married. My wife's from Montana. We moved back to Utah. And I started practicing law in a law firm that represented a lot of banks, real estate developers, and investors. So
Sure.
I did that first for about 10 years.
And then was that the transition into banking, or how did you transition into commercial banking?
Well, I tell young people that I help mentor that there'll be days in your life that are different than the day before. And one of my banking clients came to me and asked, would you consider coming on full-time to the bank and be our full-time in-house legal counsel? And I made that decision and left my law firm and went into the bank. And that really started my banking career from that point on.
I see. And what led you to First Utah Bank?
Well, I will say I enjoyed banking. I was with an old bank called Valley Bank, and then we were acquired by Bank One, and I was president of Bank One. And I really enjoyed running and operating a bank, being on the team, if you will, rather than being an outside lawyer.
Sure.
And but eventually Bank One was acquired by J.P. Morgan Chase. So I went into the commercial real estate business with Commerce Property. So I was a commercial real estate agent for several years. And the chairman of First Utah Bank contacted me and asked if I would join his board of directors.
I see.
So I got sort of back into the banking business. And then shortly thereafter, he asked if I would come on full time and run the bank.
So is First Utah Bank what we would consider a community bank?
First Utah is a community bank. And what that means, the answer is in the name. We're headquartered here in Utah. All of our locations are in Utah. We know the Utah market extremely well. Our employees and customers and owners are all here in Utah. So that's really our market focus.
And do you have an emphasis? Is the bank a retail bank, a commercial bank? Do you emphasize one over the other?
We are primarily a commercial bank.
Mm-hmm.
In Utah, credit unions and some other banks really dominate the consumer lending business.
Sure.
On credit cards and mortgages and things like that. We kind of pride ourselves on banking business owners. We do a lot of SBA, USDA government program loans. We finance a lot of real estate construction. So we are primarily a business-oriented bank.
What's the difference between, or how do you look at the difference between a residential loan and a commercial real estate loan?
Well, there's a big difference. A residential loan, as I hope all the viewers know, is a loan made to an individual secured by a 1 to 4 family residence. That's
Mm-hmm.
sort of the legal definition, but you would know it as a mortgage, either owner-occupied mortgage, a conventional mortgage,
Mm-hmm.
or a non-owner occupied mortgage, which is a great way to finance an investment property up to 4 units. Sort of thereafter, depending on the legal structure of the owner, corporation, LLC, partnership, or the type of property, we would classify that as a commercial loan.
I see. And what's the attraction to a bank to make commercial loans, given their size, the complexity involved? What's the motivation for a bank to take that additional risk?
Well, it's a great question because it's a lot harder to do it. Mortgages tend to be very, very typical and common. All the requirements and the underwriting and what you need to sell the loan into the secondary market. A commercial loan, you have to really get in and understand the ownership, the property we're talking about, the business, the cash flow, the appraisal, the loan to value, the sources of repayment, the tenants that might be in the building. If it's owner occupied, you want to understand the cash flow of the operating business. So every deal in commercial banking is unique. There's no formula.
Sure.
And we employ very good loan officers and credit underwriters that sort of dig into all of this stuff. And then we make the decision. An important factor as a community bank, we make all these decisions locally. So our loan committee, our board of directors are right here. So we can usually move very quickly. We can ask more questions if we need them, and we know the market. Because of our experience and my experience in commercial real estate, we can look at a project or a property very quickly and say it's in a good location. We know the submarkets like Sugar House or Draper or Fort Union area very well. We can almost know if the building's on the wrong side of the street.
Sure.
That's what comes with local knowledge.
Given the complexity and the size of most commercial loans, are you willing to make a look or take a look at a first-time commercial real estate investor? Or do you expect your borrower to be, shall we say, a little more experienced and sophisticated?
Well, we would really look at the project and the knowledge and experience of the owner. That's a key factor in underwriting any commercial loan is who is the management, what is their experience, their know-how. We would look to see if they've done their due diligence, whether they have some of their money in the project. And I hope we could give them advice and our input on the project.
Sure.
But the answer is certainly we would consider that. Everybody kind of has to start somewhere.
Is it possible to identify which of the two, the individual or the property, is most important in your credit decision? Or do they carry basically equal weight?
In a commercial loan situation, we really do want the property to sort of justify the deal.
Kind of stand on its own,
Yep.
so to speak.
But you have to separate that into owner-occupied properties
Sure.
and investor properties. So if you're speaking investor properties, it's critical for us to look at the building and the tenants, which is a key consideration, and the cash flow, because our goal would be that the building, the property sort of carry itself, that it debt services and can pay the loan. But our interest is no different than the owner, because he or she will want the same thing.
Of course.
But then we look at the character, the experience, the knowledge. If a completely inexperienced person wanted to build a medical office building, we would probably try to convince them otherwise.
Yeah.
Because-
Does First Utah hold its loans in the portfolio, or do you sell them?
Most community banks hold their loans. We do sell loans in the sense that we might bring in what's called a participant on a large loan. If we do a $10 million loan, we may keep half, and we may have another bank keep half.
I see.
But
So you're equal partners.
that's called a loan participant.
Okay.
Yep. And that helps us diversify. It helps us be able to do more transactions. Interestingly, and we can get into the Utah market later, but we are contacted regularly by banks out of state that are very excited about the Utah market and
Looking to buy your loans?
looking to participate in loans that we underwrite. Banks in Wyoming or New Mexico that don't have the same economic opportunity we're seeing here. So
Sure.
that's been very good for us. One of our lines of business is to not just take deposits and make loans, but to make loans and participate them to banks in other states.
Brad, in the real estate area, we hear a couple of terms that have always kind of, I think, raised some questions. One is called the secondary market and the other capital markets. Can you tell us about those, differentiate between the two?
Sure. In my opinion, the secondary market is a place where loans are bought and sold as loans. For example, if we make a mortgage loan, we would sell that into the secondary market.
And would that be probably to Fannie or Freddie?
Fannie or Freddie, and it can be sold in different ways. We would sell them what's called servicing release. So we would sell the entire loan and the servicing rights that go with it. Or you can sell the loan but retain the servicing rights. So it's a way to monetize the loan, bring the money back into the bank, and then
giving you the liquidity to make the next loan.
To make more loans. Think of it as a pipeline.
Sure,
We're selling
indeed.
these loans. Commercial loans can be sold the same way, but usually we're talking about mortgage loans when we are.
Sure.
The capital markets gets into investments, not lending. Investments are they sold as bonds, that's stock. A lot of times these investments are regulated by the SEC. And there are certainly real estate type investments, REITs, real estate investment trusts, and bonds that are secured and backed by commercial mortgages or commercial real estate loans.
So would that be a commercial mortgage-backed security?
Yeah, the term CMBS, commercial mortgage-backed security, sometimes referred to as conduit loans. They're essentially the same thing. Those are usually larger loans. They can represent a wide variety of properties: medical, multifamily, industrial, office. They're usually long-term loans. They're underwritten 75% loan to value. They have pretty good yield.
When you say larger, are you talking about multi-million-dollar
At least,
transactions?
I think generally 2 million or more.
Okay.
2 million and up. These loans, they're usually non-recourse, which is unusual, meaning there's no personal guarantee. There's good cash flow. Those loans are sold into a trust, which then issues securities to investors.
So they create tranches. In other words, smaller portions.
Yes.
If the pool is 50 million, then they may divide that into substantially lower investments, maybe $2 or $3 million
Correct.
per
And
tranche.
and you could invest in a CMBS security or bond, maybe as low as 50 or 100,000, where you on your own could never purchase or invest in a commercial
Sure.
office building or a retail shopping
Sure.
center. So they're very popular investments. They tend to yield a little bit more than certainly Treasury securities, bank CDs. And they're generally pretty safe because the securities are backed by these commercial loans that are well secured, and the cash flow is really upstream to the investors.
I see. Do you offer different terms and conditions to different type loans? For example, would a commercial loan, commercial, let's say an apartment building or an office building, command a different set of terms and conditions than a warehouse or an industrial building of some kind?
We wouldn't make that differentiation solely on the property type. We would look at each project. And so what's important for us as we underwrite a commercial loan, certainly the property type's important. And of course, we like multifamily. The reason being you have a lot of diversification in your tenants. You have good cash flow. It's always in demand. It's very reactive to the market. You can lower rents and fill it up. You can raise rents if there's high demand.
Sure.
So most lenders like multifamily. We like industrial. We like office. We're concerned about retail. So,
meaning that the market, at least temporarily, has shifted from walk-in traffic to purchases over the internet.
that's right.
Is that the concern?
We were concerned, and a lot of banks are concerned with retail before COVID. And now, of course, we're very concerned about the impact of the COVID-19 pandemic on retail. Prior to that, I would use the phrase, we were looking for Amazon-proof businesses. and
I see.
And it was really online retailing that's put the real pain on
Sure.
on your normal brick and mortar retail operation.
What other type of commercial loans have seen deterioration because of the changes brought about by the virus?
Well, of course, anybody involved in the hospitality, travel, restaurant business has been highly impacted.
So restaurants, hotels, motels,
Correct.
etc.
We finance many hotels. We like the hotel business. We understand it. We like the property type and the location. So we financed a couple dozen hotels in Utah in places like Hurricane, Laverton, Springdale, Moab, St. George, Kanab. Well, and obviously, we're interested in the national park business, which has been really good business.
Sure.
No one would have expected when the COVID pandemic broke out that every single hotel in those locations would close for business and tourists would stay away. So we've had to work through that with our customers. And for the most part, they're going to be okay because we underwrote those loans very soundly initially with good loan to value ratios, good reputable borrowers with experience. A lot of them own several hotels. So, and they're doing whatever they can to make it through this.
You mentioned a term recently about, I think it's called conduit. Can you differentiate between conduit and a bridge loan, for example?
Well, conduit loans, again, is sort of another name for the CMBS program. And
Okay.
not all CMBS loans, commercial mortgage-backed loans, are made by banks. There's a lot of private lenders also, commercial loan brokers or commercial loan mortgage companies that make those loans. There's several here in Utah. So a conduit is the way to sort of get that CMBS loan into the securitization and the securities market, as I mentioned. To me, a bridge loan is a short-term loan for some reason that will be taken out within, say, the next year by a longer-term loan.
I
So
see.
we may make a bridge loan to a developer or investor that wants to buy some land than to build a building. So if a well-known national tenant, a fast food chain, or a dollar store wants a location, a developer may say, listen, we need a bridge loan to buy the land and build this, and then we're going to put long-term financing on it. So we would bridge that.
So the bridge loan connects or bridges, if you will, an event or series of events.
It bridges to usually long-term financing, but you can't put long-term financing on an apartment building or a retail center until it's leased up, stabilized
Sure.
is the word, and then you can qualify for a CMBS type loan, long-term fixed rate loan.
Would a bridge loan suggest interest only for that few months or
It's
whatever the
negotiable,
term
but
is?
that'd be very common.
Okay.
We're not talking specifically construction loans here, but in a way, a construction loan's a bridge loan. We do a lot of construction lending, and those loans tend to be 12 to 24 months, enough to get the property built, stabilized, and then we'll be taken out, if you will, by a long-term loan. Not much different than the mortgage market. We finance a lot of home builders. So they'll take out a construction loan for 18 months to build the house. It's usually a pre-sold custom home, not always, and then that will be paid off by the long-term mortgage that the homeowner will put on the property.
It is said that construction lending could be the highest risk level of commercial lending there is. Do you concur with that? And could you give some context to that?
Well, in construction lending, you take more risk.
How?
You take construction risk that it will get built, that it'll get built on budget and on time. You take market risk that things could change in the 12 to 24 months that it takes to build the property. You risk that there's change orders or disputes that can arise between the owner and the contractor. And then, of course, they have to lease it up a lot of times or get it sold. So it's an earlier stage loan, and there's more risk involved.
So the real value of the property isn't achieved until the building's complete and occupied,
Right.
or as you say, leased up.
You can think of commercial real estate as a sliding scale, where you start out with just raw ground, but as you get entitlements from the city or county, it becomes more valuable. You get zoning changes. You might have approved construction plans. You then can actually start construction and build something. So you're really adding value all along that scale until you finally have a completed, leased up, or project ready to sell.
Sure. Well, speaking of value, do you require an appraisal on all of your commercial loans?
The answer for the most part is yes, and there's two reasons. One is just prudent bank underwriting. It's just accepted that we would want to know the value from an independent appraiser.
Of course.
Second is federal law. After the downturn and the recession of 2008 and 9, the Dodd-Frank law affected all banks and lenders and requires an independent licensed appraisal on all loans $1 million and more if it's commercial, and over $400,000 if it's residential. So
I see.
there was some appraisal funny business back then, and so we're regulated by the FDIC. They absolutely would require us to have an independent appraisal on a commercial project.
I've read about a new method, at least new in the sense of the last few years. It's an automation, a computer-generated process. I believe it's called automated valuation models.
Yeah, AVM, automated
Do you
valuation
use those
model.
on commercial loans?
We do not.
Does anyone?
Not that I know of.
Okay.
And the reason is what we've discussed. Every commercial loan is unique. It depends on which side of the street you're on, how large it is, who the tenant is, the size of it, the comps in the market. I think it'd be very hard to write an AVM for commercial properties. On residential mortgages, when you get into certain subdivisions, condominium projects, I think you can use artificial intelligence or machine learning. You have a lot of data, and these tend to be more cookie cutter properties, and they don't vary in value so much. So I think AVM is a big topic in the industry. You're starting to see what are called iBuyers purchasing homes, using AVMs to value homes.
What's an iBuyer?
It's a company like a Zillow and others that are coming in, and instead of just becoming a listing service or a marketplace to put up your listings, they'll actually come in now and make an offer on the house and buy it.
Oh,
They don't
really? So
intend
they'll
to
buy
live in
it, put it in a portfolio, and rent it out or remodel or sell it or something.
Fix it up, repair it, and then usually list it and sell it and make a profit.
I see.
A typical model for them would be to maybe get their own appraisal or their own AVM. If the home appraises at 400,000, they'd probably come in with, say, at least a 10% discount.
Mm-hmm.
Now, that sounds expensive, but if the homeowner sells it and pays a 6% commission anyway and doesn't know when it might sell and needs flexibility to acquire another home or move, it might be worth it to them.
So timing.
Yeah, I don't think they're dominating the market. I don't know if they ever will, but it's a new business model that is certainly out there.
On the commercial side, we frequently hear the term net operating income. Can you define that for us?
On commercial loans, especially investment properties,
Mm-hmm.
we focus a great deal on the NOI. Anybody involved in commercial real estate would understand that term. And it's important to understand. So let's say you start with rent of $100,000. Most calculations, including ours, and a lot of appraisers, a lot of buyers would say, well, let's adjust that gross rent for some vacancy that may occur over time. So they whack off, say, 4 or 5%. Let's adjust that for long-term reserves. Eventually, we need to replace the roof or the parking lot. We better set aside 4 or 5% a year for that. That gives you what's called your adjusted gross income. So it may be 90,000, not 100.
Mm-hmm.
But then we have to deduct our expenses, our taxes, our insurance, our maintenance, our management fees, things like that, which might be another 10,000. So now you're at 80,000. So you say, where did my 100,000 go? So we would really focus on that 80,000. What is the cash flow over time available to service the debt?
Sure.
And if the loan payment's 70,000, you're in good shape. So we would look for the NOI to cover the debt service. The formula would be, say, 1.2 or 1.3 times.
Mm-hmm.
So there's enough cash flow, net cash flow, or net operating income coming off that property to service that debt.
So the NOI, or net operating income, then is the gross revenue minus expenses, and you tie that then in relation to your debt service.
Correct.
And as you mentioned, there's a kind of a magic ratio of, what'd you say it was,
1.2 times, which would mean that the net cash flow would pay the annual loan payment 1.2.
Okay.
Now, if the ratio is 0.8, what that tells you is there's not enough cash flow coming off the property to service the loan.
To make the payment.
So we would then say we need a larger down payment, or you need to get higher rents.
Sure.
We wouldn't just say no, but we would like the property to sort of pay for itself.
Of course.
But let me make an important point, Gary. A lot of that NOI, and you'll see this a lot in this current heated real estate market, it depends on the terms of the lease if you've got an investment property. And I hope everybody knows the difference between a full service lease where the owner is paying these expenses, a triple net lease where the tenant is paying the expenses, and triple net means the maintenance, the taxes, and the insurance for the most part, and an absolute net lease. What's an absolute net lease? You may have a Walgreens store or some other tenant that says we'll pay for absolutely everything, including roofing and parking lot and HVAC systems. So you could make the case that the NOI in that case is the same as the gross rent if the tenant is truly paying all those costs.
Sure. Is there some way of using the NOI to determine value?
Yes, that gets into the cap rate calculation. So
What is cap rate?
the cap rate is called the capitalization rate, and it's really the yield that an investor is willing to accept on a property.
Okay. So that's their return goal. That's their investment objective.
Correct. So let's say the NOI is back to my $80,000 in the example I used. And an investor says, I will buy that at a 5% cap rate or 5% yield. So you would take that 80,000, divide it by 5%, and come up with a number. Off the top of my head, that number would be, say, $1.6 million.
Mm-hmm.
I believe 80,000 is a 5% return on $1.6 million.
Okay.
So the buyer may say, I'll pay $1.6 million for that. Now, if an investor says, I'll accept a 4% return, they'll pay more than $1.6 million. It's really, what am I willing to pay to get the yield that I'm looking
Sure.
for?
Is there a relationship between that percentage and perceived risk as it goes up or down?
There is, yeah, absolutely. And one thing I would caution everybody to be careful of are things like single purpose properties. We would probably charge a little higher rate on a loan, and I think investors would want a little more return on, gas stations or car washes, things that can only be that. Properties like storage units and multifamily apartments, leased up single tenant properties like Family Dollar or Goodyear or Walgreens, things like that, would command a much lower cap rate. They're highly desirable, and the cash flow is very predictable.
Sure. So the higher the cap rate, the higher the perceived risk.
That's right.
But there is no true market cap rate day in and day out. That'll vary from investor to investor?
Well, there are trends in the market. I mean, cap rates are set a lot, to some extent, by what interest rates are doing in the overall market. So as interest rates have come down recently due to changes made by the Fed, people are willing to accept lower cap rates because they're still better than Treasury securities, bank CDs, bonds, stocks, things like that. And there's also so many tax advantages to owning real estate. A phrase I would throw out, we don't have time to discuss, is the tax equivalent yield. So I might get a 5% cap rate on a real estate investment, but in addition, I get depreciation benefit on my tax return.
Sure.
And I can shelter some of that income. And of course, that property will appreciate over time as it becomes more valuable, and I'll build up equity as the loan I have pays down. So there's advantages to owning commercial real estate.
Indeed. How do you set interest rates on a commercial loan? Is there a simple answer to that?
There's a complex answer to that. We look at our whole net interest margin on our portfolio, what we're paying for money in the market on deposits, what we're trying to earn to cover our costs. So we may price a loan at, say, prime plus 1 or prime plus 1.5. It depends if the loan floats. So if rates adjust, the loan will adjust, or whether we fix the rate. If we fix the rate for 10 years, then we're taking the risk that rates may go up and we won't benefit in that. So it depends. Is it fixed? Is it floating? What's the loan to value? Is there a relationship to be had? That's very important to banks. Don't ever think that banks are just transactional in nature. We're always looking for good customers that bring repeat business, refer business, bring deposits to the bank.
Sure, that makes sense. Do you require a personal guarantee on all your commercial loans?
For the most part, we do.
And that's standard in the market?
That's standard, sort of accepted bank underwriting, because the owner, it's not just a financial guarantee. We're not looking just to try to collect from the guarantor. Hopefully that would never happen. But the guarantor is usually the owner of the building or the company, and we want the owner fully involved.
Of course.
They're making the decisions. Sure. They're in a position to sell the property, bring in investors, refinance it. So we want them fully involved. We will occasionally go what's called non-recourse, which is no guarantee, if the loan to value is really low. So if we've got a building and somebody's done a 1031 exchange or put a lot of money down, let's say it's $1 million building and you've put $500,000 down and the loan to value is 50%, we may well go non-recourse because we understand there's plenty of good collateral for us.
Well, Brad, we have time for one final question. How do you see the general real estate economy in 2021?
Well, the easy answer is we're lucky to be in Utah.
What do you mean?
Utah continues to grow. Before the COVID-19 crisis, there was already pent-up demand for housing in Utah. We were short 30, 40,000 housing units. Everybody's seen these apartments going up absolutely everywhere. They're being leased up quickly. Apartment vacancy, despite all the new units coming online, continues to hover probably in that 3 or 4% range. So you're not seeing things like move-in special, free rent, a lot of incentives. So there's huge demand. I talked to my friends at Cushman and Wakefield, and they would say, and CBRE and Colliers, I have friends all there, and a lot of the money coming in Utah from out of state. Utah is really on the map, so to speak, and people want to own properties in Utah. So I would say a big percentage of the buyers are out-of-state buyers now.
Well, that's great. Good for the economy, good for the banks, and good for the population. That concludes Stringham Real Estate Edge. Today's program is brought to you by Stringham Schools, educating real estate professionals since 1989. Visit stringhamschools.com to learn more. We want to thank today's guest, Brad Baldwin, and don't forget to tell us what you think in the comment section below. I'm Garry Barnes, and I'll see you next time on Stringham Real Estate Edge.